In today's video, I am going to be breaking down some of my favorite high dividend stocks. Some of these I do invest in while others I don't. However, when it comes to high dividend stocks, the ones that pay 6, 7, and even 8% dividends, some of these can be risky. So let's get down and let's check some of these out. One is also not a massively high dividend, however, huge growth. So this is kind of a hodgepodge of fantastic dividend stocks. Let's get down, let's check these out. However, you may be buying quite a bit of this stock at the same time, or at least in each order, because it is only a $10 stock. So if you were to buy, let's say, $10,000 worth, that would be around 1,000 shares, which at that point is still not that much when it comes versus the average volume. However, if you start buying, let's say, 10,000 shares, which would be about $100,000 worth, at that point, you may be seeing a harder time to get in and out of this stock. From there, however, that dividend is absolutely insane, and the PE ratio is also not crazy either. Now, when it comes to the 5-year chart, we're going to really delete what's happened recently and look at the long-term chart before all of this happened. And that was, of course, nice steady growth that is slightly volatile at times. However, it is a nice slow growth up. Of course, during the pandemic, there was some uncertainty about real estate investment stocks, and because of that, they absolutely plummeted. However, something that you will find out is they actually never really changed their dividend, which means that if you could have got it here, that would have been an absolutely massive purchase when it comes to a dividend. As we can see here, there hasn't really been any massive downturn when it comes to the dividend. We can go back even farther and we can see that the dividend doesn't exactly change. Now, back June 29th of this year, it did give a special dividend of 37.6 cents instead of a 0.069 cent dividend. Now, this would have been even higher and absolutely ridiculously fantastic, especially if you purchased it when the stock was actually only 40% less. And why I say that is, at the time of that low, let's just round off to say $6. From its high, or at least where it's at right now, if we call this $10, that's a 40% or a 40% decrease from where it's at right now, and about a bigger, about 45% decrease from where it was at before. And why I mention this is, if you go and add roughly 40% to that 8.5%, this was actually a little over 11% back when this downturn was happening, which is an absolutely ridiculous dividend. And when we start seeing small things like a special dividend, just imagine how much money you would have got there. Now, when we do look at the financials, we did see 2020 take a hit, which of course does happen when, of course, pandemics happen. And of course, the thing to really worry about when it comes to real estate stocks, REITs, is the fact that they will usually get hit first in a recession, and they will recover usually last in a recession. So keep that in mind. I personally don't buy REITs, at least up until recently. I'm starting to look at them. However, they've always, for all the ones I've looked at before, generally don't go up in value. They usually stay pretty close to the same. I'm finding new ones like this one to me. Now, this is new to me, of course, but this is just because I have very little experience when it comes to the REITs, is because, of course, now the next recession that we have, I'm going to start piling money into REITs because their dividends will be exploded higher, mainly because of the recession, and the price decrease of the stock means the dividend percentage goes up. And as long as they don't decrease their dividend at that point in time, you're going to be getting a heck of a deal. Now, this is the one that doesn't have a massive dividend. However, you are getting, with Canadian Apartment Properties, CAR, you are getting a 2.36% dividend. Volume is massive. However, what I really like to see is this. That's the chart. Now, of course, this is not a massive dividend stock. However, when you start seeing a REIT that, of course, increases like this one does, seems like a really, really good investment. They also just recently raised their dividend as well, and they generally pay the exact same dividend every single month as well. Just like mostly all the other REITs, we did see a little bit of a negative earnings story versus 2018 and 19. However, revenue-wise was still on the uptick, which is an absolutely fantastic thing to see. Next is TransCanada, TC Energy Corp, TRP on the stock market. Now, of course, this one does pay 5.7%. And oddly enough, when it comes to TransCanada, we all kind of think about the pipelines and, of course, the issues that they've had in the United States with Biden and all of that fun stuff. However, when it comes to TransCanada, something that I really do like is the fact that they are starting to transition over to renewable energy. Actually, in fact, right on their website, on May 10th, 2021, they posted I guess you could call it a blog article, where they basically, the title is Expanding Our Renewable Energy Portfolio, and this is just basically an article that shows that they're getting more into wind and the sustainable energy investments. Approximately 75% of power capacity is emissionless, which is absolutely fantastic. And in the US, 5% of their natural gas compression fleet is electrically driven as well. So they are basically starting to get into, of course, renewable energy, and that's exactly what you actually want to see. And basically what they're doing, or how they're doing it, is by using wind and solar and using storage to be able to serve their existing power demands. Now, if they can continue to expand this, they would actually be a customer of Tesla, so most likely. So keep that in mind. They have massive volume as well, and they tend to be trading sideways over the past couple of years, over the past 5 years. Of course, they had a nice ramp up going into 2020. However, pandemic issues happened. And of course, when that comes to the pandemic, they're going to be most likely one of the last to recover as well. And what I would really like to say is, of course, this seems to be a very good time to get into the stock, especially if they're going to get into renewable power. They also increase their dividend very, very frequently, which is something that I do like as well. However, their revenues are declining, but their earnings are going up. Now, this could mean many, many different things. However, how I personally look at this is, of course, if their revenue is going down slightly, but their earnings are going up, that means that they're somehow saving money somewhere in the middle, which means that this is going to be a continuously prosperous, very profitable company in the future. Of course, they've beaten all of their estimates over the past year as well. Now, the next company that we're going to talk about is Enbridge. Enbridge as well has a renewable energy basically future, and it doesn't show on their website when this article, what I'm reading right now, is obviously been written. However, their initial investment was in a wind farm in 2002. They've committed more than $7 billion in capital to renewable energy and power transmission projects currently in operation or under construction. To date, they have invested into 23 wind farms, 7 solar energy operations, 5 waste heat recovery facilities, 1 geothermal project, 1 power transmission project, and 1 hydroelectric facility. So that is very, very interesting. On their website, if I just Googled Enbridge Renewable Energy and it came up, it actually gives you a breakdown of how much electricity that they are generating off of each one of their things that they're doing, like the Tilbury Solar Farm, Sarnia Solar Project, things like that. And it's actually quite interesting and looking like a very, very good company going into the future. Now, when we break down the stock, we can see that, of course, the forward paying dividend is 6.5% as of right now. Average volume is 7 million shares, and the PE ratio is 16, while TransCanada, the PE ratio was 29. So actually, Enbridge, because it's basically the same company, or at least same industry that they're in, Enbridge is actually a cheaper business to invest in. However, if you look at their 5-year chart, it doesn't exactly look very promising. You're looking at a stock that was just over 55, close to $60 5 years ago, currently sitting at $50. However, there is, in my opinion, a massive reason behind this. There's going to be lesser and lesser oil being mined and lesser oil being distributed over the next 15 to 20 years. This is a company that has traditionally distributed oil to be refined or to be used. And because of that, it's always going to have that stigma, at least in the short term, that it's an oil company. However, it's starting to transition, and remember, as a business owner myself, and you probably are too, you always have to look into the future and transition your business so that it's always viable 5, 10, and 15 years down the road, which is actually why I made this channel. But either way, Enbridge and TransCanada both seem to be able to do that, and they are currently in that transition phase. It's going to cost money. That's probably why their revenues are not massive still. However, they are still growing their revenue, which is fantastic. They're also continuously, at least for Enbridge and TransCanada, increasing their dividends as well, which is fantastic. Again, revenue and earnings this past year were down for Enbridge, which is potentially why their stock price hasn't recovered really all that much. They've had 2 beats and 2 misses when it comes to their earnings, so keep that in mind as well. Considering that the 2 beats were both 2021 beats, this to me is showing that they may have a good future coming up. And of course, Bank of Nova Scotia, and you're probably asking, why am I even mentioning a stock that's under 5% dividends when this is a video about high dividend stocks? Well, 4.6% is pretty high in my opinion. And also, Bank of Nova Scotia is a bank, which means that they were not allowed to raise dividends over the past year to year and a half, depending on the bank release. So when it comes down to it, at 4.6%, they are making more money from, or at least more profits, because of the pandemic, and because of that, believe me, they will be probably raising their dividend. Their CEO came out months ago saying that he just wants to raise the dividend. They have record cash on hand, and it's bugging them. Well, guess what? That to me means that it could be potentially a 5% stock if the stock kind of sits where it's at now, about a year from now. So, of course, we can't really tell what happens in the future, or even from past performances. So, what I would like to say is always do your own research. However, Bank of Nova Scotia, their stock seems to be pretty solid. Let me explain. So at 4.6%, they've actually been continuously paying a dividend for around 100 years, which is absolutely fantastic. They've actually never decreased their dividend, which for that amount of time as well. So that's just ridiculously crazy. From there, the volume is up there at over 3 million shares per day, and the PE ratio is somewhere in the middle when you're talking about the banks, TD being one of the cheapest at this point in time, and of course BMO and Royal Bank being one of the, or some of the more expensive. Bank of Nova Scotia seems to be somewhere roughly in the middle. Their stock prices also basically traded sideways if you basically get rid of that whole pandemic thing. They regularly, of course, increase dividends. Well, of course, not since, of course, September. The reason for that is because in Canada, there's right now a lot of laws when it comes to raising dividends, especially for banks, and they're not allowed to right now. So once they're allowed to, of course, this is going to be amazing. Like, look at this. Every 6 months, they raise a dividend, at least historically over the near term. So that to me is just insane. If you just do simple, basic, crazy math, we're averaging between 2 and 3 cents every 6 months. So in theory, if you're just looking at the cents and not the percentage, then you're looking at 2 cents, 4 cents, 6 cents, 8 cents. You are now looking at, in the future, they're probably going to be able to raise their dividends sometime next year, probably a 10 to 12 cent increase or more. So this is looking very promising. They've also beat all of the last 4 quarters. And of course, 2020, yes, their revenue and earnings were down, but they still say that they have record cash on hand. So that still is quite interesting to me. They are still making a ton of money. They're a bank. Now, if they turn into more of a BMO, where BMO's been killing it because, of course, just like every other bank, they're charging for everything. However, BMO, they've been creating their own ETFs, and it's quite interesting. So if more and more of the Canadian banks follow along in that path, then it's looking quite interesting when it comes to the Canadian banks. I hope that you've enjoyed today's video. If you have, hit that like button and subscribe, and I'll see you guys again next time. Let me know what your thoughts are down in the comments section below.